Hey, in this video, I'm going to talk about the how employee stock purchase plan ESPP is taxed at a federal level. So, ESPP plan there's qualified and non-qualified. So, non-qualified, you not really benefit all those tax favorable treatment. So, we are not talking about that here. So here we only focus on qualified plan, which is created by the IRC tax code 423. So the plan requires you have a holding period requirement. So when you meet the holding period requirement, so and you sell it, that's called qualified disposition. So when the requirement of the holding period is 2 years from the offering period, which is 2 years from the grant date, 1 year from the purchase date, which is also called exercise date. So this is you have to meet the both of the requirement in order to enjoy a long-term capital gain. So majority of your gain will be long-term capital gain, except if your plan offer you a discount, the discount amount is ordinary income. Otherwise, everything is long-term capital gain. So I'm going to show you an example here. Say your employer granted you an option on its qualified ESPP to buy 1,000 shares of the stock for $17 per share at the time when the stock had a fair market value $20 per share, 15% discount. 6 months later, when the fair market value of the stock was $30 per share, then you purchased the stocks. 20 months after the purchase, you sold the stock for $50 per share. Okay, and you can see here is 1,000 shares. Offering date, which is granted the fair market value, is $20 per share. However, you offered a 15% discount. 15% discount of the $20 is $17. So when you purchase it, 6 months later, you purchase it, you purchase at a discount price of the grant date, right? So this is exercise. You could say this purchase and exercise is the same thing. Then when you sell the stocks, so you sell after 20 months after purchase, which is 26 months from the grant date, right? So you sold at a $50 per share. First, you want to examine that if you meet the holding period requirement. Well, they require you 2 years from the grant date to sell. So you 26 months, more than 2 years, so you meet this first requirement. Then 1 year from purchase. So when you hold for, after you purchase, you hold for 20 months. So 20 months is more than 1 year, so you meet both holding requirement. So then your disposition is qualified disposition. So total profit, you can see what you sold for is $50 per share. What you bought for is $17 per share. So total, you would make a profit of $33,000. However, they say besides the discount, everything else is going to be long-term capital gain. So the discount amount is the $3 per share. You can see here. So $3,000 going to be ordinary income added to your W2, going to be taxed at the ordinary income tax rate. The rest of the money, which is the granted price and your sold price difference, is $30 per share. So this will be $30,000. So those will be taxed as a long-term capital gain. So here long-term capital gain because you hold the stock more than a year. So you can see here the benefit long-term capital gain is much beneficial because at a lower tax rate, then also you are not subject to FICA tax on this. So that's you understand, how this tax requirement for you to, if you meet the holding period requirement. Okay, let's see disqualified disposition is you are not meet the holding requirement of this one. So here they tell you only the gains after purchase are capital gains, short term or long term. So let's see the example. This is exactly the same example. However, I'm just changing instead you hold 20 months, you hold only 10 months after purchase, then you sold the stock. So everything else is the same, discount are the same, purchasing price are the same. So everything else is the same besides you. Here, hold on to this one. And so look at the holding period. So they say 2 years from granted. So this one you are not meeting the requirement. You are not 2 years, only 16 months, right? So 1 year from from purchase, you are not meeting the requirement either. It's only 10 months. So I can show you 10 months have another implications. The total profit is still the same thing, but you will be taxed differently. Now, as an ordinary income on your W-2, now it's increased to $13,000. Why? Because now is from the purchase. The fair market of purchase is $30, not from the granted now, is from the purchase. You can see this one is 13 $13 per share difference. So then you will get $13,000. This is ordinary income tax or the ordinary income tax rate. Then the rest of it is gonna be as a capital gain. However, you only hold the the stocks 10 months, which is less than 1 year. So your capital gain will be short-term capital gain. So in this situation, then the rest of the $20,000 you will be taxed as short-term capital gain, exactly the same as the ordinary income tax rate. Just the report differently is going to be on the Schedule D. So that's how this tax implication on the qualified ESPP when you meet the holding period requirement and when you are not meeting the holding period requirement. So it's very important for you to understand if you want to utilize the the favorable tax treatment as a long-term capital gain.